Hello and welcome to the inaugural episode of our special series, Your Money in Pandemic Times, brought to you by Mirae Asset. This is a special broadcast where we will talk about how Corona has disrupted the way we invest and where we put our money and how the SIPs behave. What should we do about SIP? In the first episode, we will talk exactly about that, about what you should do about your SIP investment and where the money should go. We are delighted to have today with us Mr. Swarup Mohanty, the Chief Executive Officer of Mirae Asset. Thank you, Mr. Mohanty, for joining us and taking time out for this special broadcast.
Thank you, Mr. Mukherjee, for having me with you. These are very interesting times, so we hope to have a meaningful conversation here.
Yes, I hope so, because a lot of people are worried about what happens to their money in these difficult times. The stock markets are behaving very irrationally. So people are worried about where to invest, what to do. Today, of course, we will talk about SIPs and what is happening with these SIPs, because that is one of the most popular ways of investment for people. So the first question I would ask you about is that because of the panic and the volatile markets, individual investors who participate through SIPs are either redeeming or discontinuing their investments. Is that a wise thing to do under the circumstances?
Thank you for asking me that question, because yes, though there is a lot of talk about people discontinuing their SIPs, the last month's data just showed a 3% dip, which means that maybe the noise is a little more than what is happening. We'll have to wait for a month or two to really conclude that. But I do agree to the sentiment of the question, because when such an event of this abnormality happens, the markets react in a very different manner. And when the markets have reacted the way they are, it is natural that some of the investors, or particularly the new investors who have not gone through earlier such situations, start thinking about their money. It's a very natural reaction. There is nothing wrong with it. But when you look at the concept of SIP and when one invests in an SIP, I do believe that an SIP started with a goal, and there is a purpose to why the person started the SIP in the first place, right? But when such abnormalities happen and we see these kind of dips in the market, the thought of whether to continue, stop, or remain invested is bound to come with the investors. But let me tell you that volatility is the best friend of an SIP investor, and these are the best times in the journey of the SIP for an investors, for all investors, because it is at these times that the SIP gets the biggest benefit of rupee cost averaging, because it starts accumulating units at a far cheaper price than it was in normal times. And when you expand that over a period of time, this accumulation of units at the lower price starts giving you results over a long period of time. Let me give you one great example, and because I've personally gone through it, I'd like to bring out that example. Let me bring you an example of, say, an SIP which started in 2008, just before the financial crisis, and I'm relating to that with this similar situation now, because what has happened, though not to the extent of 2008, but very similar situation. So if somebody had started their 10,000 rupees SIP in 2008, and that were to continue today, say the 10,000 SIP in the Sensex would be valued, say, around 22.9, almost 23 lakhs. Now, between the period June 2008 and July 2009, there was this volatility which is similar to what we are seeing now. If somebody would have stopped the SIP at that point of time, or have got out of the market at that point of time, or would have stayed out of the period of, say, these 12-14 months, one would have not participated, say, around 1.5 lakhs or 1.4 lakhs, that amount. If somebody would have stopped that SIP and not participated, his actual returns would have gone down to around 18.8 lakhs. But while participating in those 14 months and accumulating that SIP period, entire period in the market at a lower price, the return, would have gone up by almost 4 lakhs. So this incremental 2 lakhs or 2.5 lakhs which one got is due to that entire downturn in the market, and one benefited by staying in that SIP. And that's something which every investor should keep in mind when they look at SIP investing, because the biggest advantage of SIP comes out in these periods, and it is being rational and looking at it more mathematically than getting a little emotional. You create money by being more mathematical, and you lose money by being emotional, and that's something which is very important to keep in mind. I know it is tough to be rational, but if you have to create wealth, one has to remain very focused on the process, and the process would say remain invested, unless you have a cash flow problem, and that's a very separate sort of discussion altogether.
We'll come to that. But what more than emotional, one of the important things that we need to sort of take into account is fear. A lot of people are acting irrationally because of fear that their money will be lost. Is there
Yeah.
anything to fear in these times? Because one, people are redeeming and withdrawing from the market, and the second thing is they are not putting the amount of money they used to in the pre-COVID times, and that is
Right.
all out of fear.
At the outset, this is a medical emergency, and I do agree if it extends for a long period of time, it can sort of get into an economic crisis, right? But the world around, people are, trying to find a cure for this, and sooner or later, if you look at a 25-year horizon of my working in this market, I have just seen 5 such instances. And a crisis like this does not happen often. And every crisis comes with its own challenge, and every crisis comes with its own opportunities and challenges to us. But every crisis has come with a start date, every crisis has come with an end date, right? And the world upgrades very quickly post the crisis. If you look at the 2000 crisis, which taught me that a sector fund brings a certain amount of risk, it's not that such crises have not happened after that. And it's just a matter of time that the world upgrades to that crisis. Not that after 2008 financial institutions have not faltered, but we have not seen that kind of volatility in the market at this moment. Yes, when such an impact comes to us, I do agree that fear is the first sort of factor that comes into the mind. Unless one thinks that everything is over and life will come to an end, then that fear is sort of valid. But I do believe at the bottom line, the companies remain intact. Yes, some amount of slowdown can happen in the near term, and in that slowdown comes these opportunities. Some of the large companies which are available at some of the values now were not available just in December last year, right? So if one believes that this impact is permanent, I will agree to that fear, and that is the difference between looking at it emotionally and not emotionally. If you ask that question and spread your horizon to a 2-3 period time, your own answers will be very different. That's the submission.
I would go to another area which you touched in your last question, that is of cash flow problem. Now, a
Yes.
typical problem is that due to the lockdown, if someone loses his job and is unable to subscribe to his monthly SIP, what will happen? Can he reduce or hold or pause his monthly SIP commitments? How will it impact achieving his investment goals overall?
Yes, if there is a case of job losses, which is a possibility, I do agree. And in this moment, again, one would really start reflecting on the finances. But before that, I'd like to bring it back what has happened in this COVID scenario. And let me take myself as an example. It's definite that the earnings of this year for the balance sheet of my company will not be what it was for the last year. So our earnings will definitely at a personal level will not be what it was for the last year. This is a given, right? That's the impact of COVID. And sooner one realizes it, the better one can become a little rational, right? But what this entire COVID period has done in the last 3 months is that, in anybody's personal sort of expense statement, there is a need and there is a want, right? In these last 3 months, even if I wanted to spend some things, I were not able to spend. So there has already been a forced saving in the last 3 months, which is very important in the expense statement. One is to look at this as an opportunity to create a buffer for the bad days which can come, and that is very important. It is what you do with this forced saving that has come in. One should get very rational about it and look at pay off probably some of the credit cards which people accumulate, some of the loans that one can, because the want part of every salaried individual is definitely high, and sometimes when the wants overtake the needs, the EMIs come in, right? Correct me if I'm wrong. So these last 3-4 months and the going next 3-4 months have been a good opportunity for some accumulation of money in everybody's expense statement. So one has to first rationally view that accumulation which has happened, and if one foresees that there will be a loss in this cash flow going forward, this 6 months accumulation should be put in the rightful use, right? That's point number one. Point number two is, yes, you can definitely pause your SIPs, and there is no harm in pausing an SIP because you don't have cash flow. That is probably a prudent thing to do. The non-rational thing would be to redeem the SIP. If it comes to that, maybe one day you will have to dig into that and do it. But my humble request would be, put that as the last resort, right? But these 6 months of savings should be reutilized in the right manner to sort of extend this period of pain that could come for one can foresee. But stay invested. Yes, if you want to pause it, and as I said, the impact of pausing will definitely come, and it could take away the goal, or it could shift the goal by some period of time to the period of time which one stays away from the market. It could also get impacted if the rebound is pretty severe in the market. If the rebound of the markets comes very quickly, like it did in 2011-12, then the number of units accumulated actually hastened the process of goal creation, goal destination. So these are the two risks that one carry when they pause the SIP. One, obviously, but what the good part that can happen is, because you have a goal in mind, you would know how much you have deviated. So when the cash flows come back, you can then realign by adding a topping up of an SIP to get back to the goal. Nothing is lost, is what I can say. Yes, you would, because you have a goal in mind. A person with a goal in mind is in a far better state at this moment to address the COVID issue in the financial statement than a person without a goal, because he or she would know exactly by how much you have deviated. And in times when the cash flows come back, you can talk to a good advisor and get yourself back on track. But yes, to answer your question, you can pause the SIP, but my humble request is, try resisting from redeeming the SIP, because then you would derail your goal perpetually.
Thank you. This was a good sort of advice to investors. One last question that I want to ask you is that equity markets are in a dire condition now, and the debt markets too are equally bad, and there are some examples which have actually aggravated the fear factor due to global slowdown and thanks to the pandemic. So in this scenario, what should investors expect from their mutual funds?
See, typically mutual fund is a pass-through product, and mutual fund in a way is a reflection of the underlying market. The expectation when you hire the fund manager is that the fund manager should have the ability to do better than the market. That is why you pay that basic fee to the fund manager. If the markets crash, to expect mutual funds not to crash is fundamentally flawed. The crash should be lesser than what the underlying market is. That is the primary job of a fund manager, right? At the same time, when you look at this kind of a pandemic, it is also not possible for the markets not to react in an adverse manner. It's a given, and it's not just an India specific sort of thing, it's a global thing, and it will remain as long as we do not find a solution to the virus. It's a reality that the virus is currently ruling the start and the end date of this entire period of time. So when you look at, and this is just basic investor behavior or philosophy, is that one has to always focus on what one can control, and what one cannot control is how the markets function, right? What one can control is one's own asset allocation. And in these times, I will again reiterate the factor of being a little rational, because what can happen if you extend the same discussion to a period of 3-4 years will be very different when you look at it from a 6-8 period month of time, right? The only thing that I can do, or what I can control from my investment perspective, is my asset allocation, and the sensible thing would be to retain the asset allocation, because that is a controllable, right? The other part, as you rightly said, is assess whether you are on track on your goal. If you have derailed a bit, take the corrective action. This market is giving some very good opportunities for every investor to rebalance the portfolio. What used to be a periodic review, one can do the review at this moment of time, and with advisory help can take some necessary changes in the portfolio. Is what are the two things that one can do very, very significantly well, and that is the only controllable. And that's what one should rationally do, because this, as I reflected in the last question, is that this 6-8 months has given us some surplus in our cash flows, and hence this opportunity, right, to look at it in a right way and make the corrective action in the respective portfolios. If we start discussing on how the markets will behave and how policy making will behave, those are things which are not under our control. So it is sticking to the basics and just doing what you can control can give you an opportunity of creating some changes and for the better in the long run in your portfolio. And that's always happened. I can prove it mathematically that in all these volatilities, there are immense opportunities which come up. But if one remains a little rational and behave in a systematic and mathematical manner, one can make the benefit of what we call a crisis alpha in these kind of situations.
Thank you so much. So friends, you can see that there is no need to panic. You can stay invested. You can sort of use your money in a better way. There is no need to redeem your SIPs. And as Mr. Mohanty says, the market has given you opportunities in this crisis alpha situation where you can still make your money, put your money to good use. Thank you, Mr. Mohanty, for your time and sharing your valuable thoughts. That's it for this week's episode of Your Money in Pandemic Times. But do not forget to watch the next week's episode the same time next week. Thank you so much.
Thank you so much.